The 60 to 70% or so Americans still willing to trade effort for a paycheck are divided into two wealth classes. The first class is the working class to pay monthly bills, all while attempting to build wealth, which is capital. The second class has wealth and is now trying to preserve it, or maybe better put, not lose it. The option to own physical gold is reserved primarily for the second wealth class, but not exclusively. For your information, the ones living check to check most often end up selling physical precious metals as soon as times get tough. Now let's take a look at publicly held debt that is skyrocketing. Runaway spending, especially on Medicare, Medicaid, Social Security, will drive the federal debt to unsustainable levels. Total national debt includes publicly held debt, or debt borrowed in credit markets, and debt that one part of the government owes to another. This, including the intragovernmental debt, the national debt, already exceeds the size of the nation's economic product, the GDP. Now, looking at this chart over here, the publicly held debt back around World War I was approximately 30%. During the Great Depression, it was around 40%. Now, during World War II, it started to increase, and by 1946, we were at 106%. From about the early 1950s, these publicly held debts started to decline, and they plateaued for around 30 to 35% for about 30 years. Then we got to what was considered the Great Recession, where the stimulus and bailouts occurred around 2009 or 2010. Now here we are in 2015 at 74%, which is a higher publicly held debt than what we had back in World War I and the Great Depression. It is marked that by 2028, we will pass the 100% mark once again. Now, this information is taken from the public debt as a percentage of the GDP. The next thing that we want to take a look at here is the Social Security deficits. It is permanent and it is growing. The Social Security began running a cash flow deficit in 2010, paying out $51 billion more in benefits than the program received in payroll taxes that year. Without reforms, Social Security cash flow deficits will rise rapidly and will quadruple in less than 20 years, when its combined trust fund would be exhausted. Now, if you look over here, this chart is in relation to inflation and adjusted dollars as of 2014. If you look at the chart up here, it shows that here in about 2008 or 9, the system was working pretty well. We were in the positive, and we weren't in any deficit at all as far as Social Security deficits go. Now, as you look at 2010, we started to increase the deficits, and here it shows in 2014 we were at $79.7 billion in deficit. Now, that's literally the opposite of what we've seen happening in 2008 and 2007. Now, the chart here shows that by 2032 we will be $337 billion in a deficit. So what does this mean? When it comes to retirement, we can no longer depend on Social Security income. So for those of us that have been paying into Social Security all these years, we really can't count on there being any type of Social Security income for us.